Welcome to Breaking News to Trading Moves. Imagine you are a massive terrestrial telecom company.
Right?
You have spent a century and frankly countless billions of dollars laying down physical cables, negotiating land rights, and just building this massive network monopoly.
A literal physical empire.
Exactly. And then you wake up one morning and realize a global retail and cloud computing giant is preparing to bypass your entire physical infrastructure from space.
Yeah, that's a terrifying wake-up call.
It really is. So our mission for you today is very straightforward. We are looking at a specific business headline, and we are going to break down the clear winners and losers.
Yeah, and to be clear, no exaggeration, no hype here.
Right, none of that. We are taking an objective look at how the market reacts to major corporate actions. So the headline on the table today is this: Amazon is eyeing a deal with Globalstar.
Yeah, and when we look at the core premise of this reporting, it tells us a few very specific things about the current market environment.
Okay, lay it out for us.
Well, this potential deal signals that low Earth orbit satellite connectivity is becoming, much more competitive and certainly more valuable as an asset class.
Because it's not just a rumor in a vacuum.
Right, exactly.
Right.
Beyond just a single transaction, it shows Amazon is willing to spend aggressively, like really aggressively, to scale its satellite ambitions.
Okay, so Amazon eyeing a deal with Globalstar sets up a really clear set of market reactions. We are going straight to the epicenter of the headline here to look at the companies directly involved in the potential transaction.
Immediate players.
Exactly. We want to examine how the market prices their immediate risk and reward, starting with the primary target.
Right, so Globalstar is the most direct beneficiary here. And for anyone tracking the ticker, that is GSAT.
GSAT, got it.
So if a transaction moves forward, the target company typically sees an immediate valuation premium. I mean, the market anticipates a buyout price that is higher than the current trading price.
Which makes sense.
Yeah, or at the very least, they anticipate a massive injection of financial backing that essentially removes the growth constraints Globalstar was previously facing.
Right. But looking at the reporting, the ownership structure reveals a secondary beneficiary sitting quietly in the background, and that is Apple, ticker AAPL.
Oh, absolutely. Apple's a massive factor here.
Wait, let's look closely at the mechanics of Apple's position, because that feels like a vital piece of the puzzle. Reuters reported that Apple owns a 20% stake in Globalstar.
Right, 20% is a hefty chunk.
It is. So how does a minority shareholder dynamically benefit in a scenario like this without actually doing anything?
Well, the mechanism at play here is passive equity appreciation.
Passive equity appreciation. Okay, break that down for listeners.
So when a corporation holds a stake that large,
Yeah.
any strategic adjustment of the underlying asset directly benefits their balance sheet.
Okay.
If Amazon pays a premium to acquire Globalstar, well, the cash value of Apple's 20% stake instantly increases.
Oh, wow. So they just win by default.
Pretty much. And even if this is not an outright purchase, like if Amazon just injects capital to partner with them or utilize the network that makes the underlying asset more valuable,
Right.
Apple benefits immensely without having to deploy, a single additional dollar of their own capital. They get a free financial lift based purely on Amazon spending.
That is wild. So the target and the shareholders walk away in a stronger position.
Definitely.
But the acquirer takes on the immediate market pressure. Amazon, ticker AMZN, takes the near-term hit in the market size.
Yeah, they carry the heavy lifting.
Right. And I think a good way to clarify this capital allocation risk for you, the listener, is to think about real estate.
Oh, the fixer-upper analogy.
Exactly. Buying a satellite network right now is like buying a massive, highly complex fixer-upper property. The sellers Globalstar and Apple, well, they walk away with a clean cash premium. Their part of the transaction is finished.
They get to wash their hands of it.
Right. But Amazon, the buyer, immediately takes on the burden, the ongoing costs, and, the heavy execution risks of the renovations. They have to do the grueling work to realize the value.
Yeah, the hard part is just beginning for them.
So how does that specific execution burden pressure Amazon's market sentiment in the short term?
So the pressure comes directly from how institutional investors model a company's free cash flow.
Okay.
Amazon is a massive operation, obviously, but its valuation is heavily tied to its ability to generate cash after capital expenditures.
Right, the money left over after they pay for all the physical stuff.
Exactly. So when news breaks that they are willing to spend aggressively on satellite connectivity, analysts immediately pull up their financial models and, well, they start revising the numbers downward.
Because the spending is going to be enormous.
Right. The acquisition cost is just the entry fee. Analysts have to factor in the billions of dollars required over the next several years to build, test, and launch the physical hardware.
Because free cash flow is operating cash minus capital expenditures.
Yep, exactly.
So as the capital expenditures for space go up, the free cash flow goes down.
That captures the dynamic perfectly. When Wall Street sees near-term cash flow expectations drop, the stock faces downward pressure.
Right.
Furthermore, the execution risk is massive. Building a low Earth orbit network requires putting thousands of satellites into space, maintaining them, and building consumer hardware that works perfectly. Investors heavily discount stocks when that level of uncertainty is introduced to the balance sheet.
Okay, but let me push back on that logic for a second.
Sure, go ahead.
Amazon already spends billions on massive infrastructure projects. I mean, they built a global cloud computing network. They built an international logistics system.
Yeah, they are the kings of infrastructure.
Right. So why does the market suddenly get nervous about them spending money on satellites? It seems like entirely standard behavior for a company of that size.
It does seem like it, but the difference lies in the proven return on invested capital. With cloud computing or warehouses, the market understands the unit economics. If Amazon builds a warehouse, investors know roughly how many packages it will process and what the profit margin will be.
It's predictable.
Extremely predictable. Space infrastructure, on the other hand, is a relatively unproven commercial model at this scale.
Right.
The market does not have a reliable historical baseline to guarantee that, spending $10 billion on a low Earth orbit constellation will actually yield $20 billion in profit.
There's no blueprint for that.
Exactly. That lack of predictability makes institutional portfolio managers very cautious, which is why the stock absorbs negative sentiment.
Okay, so Amazon taking on this execution risk means they are about to write massive checks.
Huge checks.
The next logical step is to look at who is cashing those checks. Amazon cannot physically launch thousands of satellites alone. They require a specialized supply chain.
Yeah, they can't do it in a vacuum, pun intended.
Right. So we look at the companies supplying the physical space infrastructure.
Investors immediately look to U.S.-listed companies tied to launch services, satellite systems, and orbital infrastructure.
Okay, who are the standouts there?
Two names that capture this attention are Rocket Lab, ticker RKLB, and Redwire, ticker RDW.
Got it.
They support the actual mechanics of getting hardware out of the atmosphere and keeping it operational.
Let's tie this to the classic gold rush analogy. We always hear the safest bets in a gold rush are the companies selling the shovels and pickaxes, right?
100%.
But let's actually attach that to the financials of a company like Rocket Lab. In this modern space race, Rocket Lab and Redwire are building the deployment infrastructure. The critical distinction here is that they do not have to win the consumer connectivity battle to make money.
Right. The capital expenditure of building the pickaxes is the focal point here.
Right.
If Amazon wants to deploy a low Earth orbit constellation, they need hundreds of rocket launches over a multi-year period.
Hundreds of them.
Yeah, because a low Earth orbit satellite does not stay in space forever. Because it operates relatively close to the Earth, atmospheric drag eventually pulls it down.
Wait, really? It just falls?
Yeah. It burns up after 5 to 7 years. This means the constellation requires constant replenishment.
Oh, wow. So it's a recurring revenue model.
Exactly. Rocket Lab provides those launch vehicles. They secure guaranteed contracts for employment.
Right.
Whether Amazon's eventual consumer broadband service succeeds or fails entirely, Rocket Lab still gets paid for the physical launch.
Because the rocket went up either way.
Yes. The market assigns more value to these companies because their revenue model is tied to the guaranteed deployment cycle, not the uncertain consumer adoption cycle.
They capture the revenue up front without carrying the consumer risk. Redwire operates similarly by focusing on the orbital infrastructure and space components.
Right.
When a giant signals aggressive spending, the total addressable market for those component manufacturers expands mechanically.
It just grows overnight.
But to buy into these launch providers, capital has to come from somewhere. The text points to a capital rotation out of legacy structures, specifically mentioning Liberty Broadband, ticker LBRDK.
Yes, Liberty Broadband.
Hold on, though. Liberty Broadband is a completely different legacy communications business. Why on earth are investors selling a traditional broadband stock to fund a space race? That feels like a massive leap in logic.
It sounds like a leap, but to see the connection, we have to examine the rigid rules of institutional portfolio management.
Okay, take us behind the curtain there.
Portfolio managers at large mutual funds or exchange-traded funds operate under strict mandates.
Yeah.
They might have a specific allocation, say 5% of their entire portfolio dedicated solely to communications and telecom infrastructure.
Right, they have rules they have to follow.
Exactly. If that 5% is fully invested, they cannot magically create new money to buy shares of Rocket Lab or Redwire.
Oh. They are trapped by their own sector limits.
Yes.
If a new, aggressive growth story emerges in the space economy, they have to free up cash.
That is the mechanical reality of capital rotation. Liberty Broadband represents a legacy ownership structure in the communications sector. Its growth model is mature and steady.
It's the old guard.
Right. When portfolio managers want exposure to the rapid expansion of direct satellite infrastructure, they must liquidate positions in companies with slower traditional growth to free up that allocated capital.
Wow. Okay.
Liberty Broadband faces market pressure, not because their core terrestrial business is suddenly collapsing today, but simply because the limited pool of investment capital assigned to communications is, rotating away from them and toward the companies directly enabling the new space economy.
Right.
The lack of buyer demand weighs heavily on the stock price.
It is a pure opportunity cost scenario. The money has to chase the highest expected yield within the sector limit.
That's exactly it.
So after the shovels are sold and the hardware is actually floating in orbit, the focus moves from the physical rockets to the service layer.
The actual connectivity.
Right. We have to look at how an Amazon-backed platform impacts the broader connectivity and telecom market. This brings us to the companies building next-generation connectivity networks, starting with AST SpaceMobile, ticker ASTS, and EchoStar, ticker SATS.
Yeah, a strategic move from Amazon heavily validates the economics of direct-to-device coverage.
Okay, what does that mean practically?
Well, AST SpaceMobile and EchoStar are actively working to build networks that connect satellites directly to normal, unmodified smartphones.
Like just the phone in your pocket.
Exactly. Historically, this was considered a highly speculative, high-risk business model. It requires massive upfront capital with no guarantee of mass consumer adoption.
That was the long shot.
Very much so.
But when a company with Amazon's balance sheet enters the arena, the perception of risk changes entirely.
The perception transforms overnight. When Amazon signals that low Earth orbit connectivity is a valuable competitive space, it tells the broader market that the underlying technology is commercially viable.
It's a stamp of approval.
Precisely. Traders react by anticipating more institutional capital and perhaps aggressive corporate partnerships will flow into this specific subsector.
Right.
If direct-to-device satellite communication becomes the future standard for mobile networks, companies like AST SpaceMobile and EchoStar, who are already building out that specific technology, become prime targets for investment or acquisition.
Because they're already doing the work.
Right. Their valuation increases because the underlying premise of their business has been validated by a major tech giant.
But a competitor with limitless pockets entering the market is terrifying for the companies already operating there.
Oh, it's a nightmare for them.
Let's look at the existing satellite competitors taking the negative sentiment hit. Iridium, ticker IRDM, and Viasat, ticker VSAT. Why does an Amazon entry specifically threaten their existing models?
The threat stems from the ruthless nature of Amazon's pricing power, combined with the physical limitations of older technology.
Okay, physics and economics.
Exactly. Companies like Viasat operate older, geosynchronous satellites. These are massive, incredibly expensive satellites that sit roughly 22,000 miles away from the Earth. Because they're so far away, the data has to travel a long distance, which creates high latency.
It lags.
Right. It takes a physical moment for the signal to go up to space and come back down.
Which makes it a tough sell for high-speed modern internet needs like video conferencing or fast data transfer.
The performance is restricted by the laws of physics. They can't fix that.
Yeah.
Amazon, on the other hand, is building a low Earth orbit constellation. These satellites operate much closer to the Earth's surface, drastically reducing latency and providing broadband speeds that mimic terrestrial connections.
So it's just a better product.
It is. Furthermore, when Amazon enters a market, they have a well-documented history of operating at a loss for years to capture market share.
They will bleed money to win.
Exactly. They have the capital to compete aggressively on price. If investors believe Amazon is going to heavily target enterprise communications and rural broadband with faster, cheaper, low Earth orbit technology, well, the growth prospects of older geosynchronous operators like Viasat look incredibly weak.
Right.
Institutional capital flees those stocks because their competitive moat cannot survive an opponent willing to absorb massive short-term losses.
That explains the direct space competitors perfectly. But the text also points to an even larger group of companies facing long-term pressure. Traditional telecom.
The really big players.
We are talking about AT&T, ticker T, and Verizon, ticker VZ. Let me ask a skeptical question for you, the listener. AT&T and Verizon are entrenched monopolies in many ways. They have physical dominance. How does a low Earth orbit satellite genuinely threaten the network reach narrative of these massive terrestrial giants?
It's a great question. The vulnerability is buried in the economics of maintaining physical infrastructure in low-density areas. AT&T and Verizon generate incredible margins in dense cities where one cell tower can serve thousands of paying customers.
Right. The cities are highly profitable.
Very profitable. But their network maps also cover vast rural and remote areas. The return on investment for laying fiber optic cables and building cell towers in a mountain range or a remote farming community is atrocious.
Just terrible economics.
Terrible. They spend billions of dollars on physical roads, power lines, and continuous maintenance for a tiny fraction of their customer base.
They essentially subsidize the remote coverage with the massive profits from the cities just so they can advertise a nationwide coverage map to the consumer.
Exactly. That business model worked flawlessly when there was no viable alternative.
Right. What else were you going to do?
Exactly. But low Earth orbit satellites operate on entirely different economics. Once a satellite swarm is deployed, it provides a continuous blanket of coverage over the Earth. The satellite does not care if the user below is standing in downtown Manhattan or the middle of a desert. The marginal cost to connect a remote user via satellite is practically zero once the hardware is in space.
Wow. That completely invalidates the terrestrial advantage for remote locations.
It completely changes the competitive dynamic. Traditional telecom companies have always used their expansive physical network reach as a primary filling point to consumers and enterprise clients.
Right. The whole "we have the biggest map" argument.
Exactly. If space-based connectivity becomes a more viable, reliable layer for mobile service, that long-term narrative for AT&T and Verizon is suddenly vulnerable.
Because the map doesn't matter as much.
Right. Investors realize that a tech giant could offer nationwide coverage without ever having to negotiate a land lease or pour concrete for a remote cell tower.
That is a massive realization.
It is. If the most expensive parts of a terrestrial network can be bypassed by technology operating in orbit, the market begins to heavily discount the long-term growth expectations of traditional telecom providers. The negative sentiment reflects the realization that their physical moat is no longer impenetrable.
So we have examined the mechanics behind the direct deal targets, the capital rotation feeding the space infrastructure supply chain, and the intense competitive pressures facing both legacy satellite operators and terrestrial telecom giants.
Yeah, and looking at the mechanics of these market reactions reveals how a single strategic decision regarding capital allocation forces the entire market to recalculate risk.
It really does touch everything.
From the passive equity benefits for Apple to the guaranteed launch revenues for Rocket Lab, every player in the supply chain is impacted by the sheer volume of capital required to execute this strategy.
We want to leave you with a final thought to ponder as you process this market activity.
Yeah. If space-based connectivity truly becomes the ultimate competitive layer for remote coverage, will traditional terrestrial telecoms eventually be forced to rent, partner with, or build their own satellite networks just to maintain their market position?
Just a reminder, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.